Peter Lynch is one of the best-known investors of his generation. He was a fund manager at Fidelity Magellan, and during his time of management, he gained an average annual return of 29% for more than a decade. This is almost double the growth rate of the S&P 500 index fund. Only a few investors can achieve a 29% gain in a single year, and you might be wondering how Lynch made it possible. Luckily, he didn't keep all of his investing wisdom to himself. Hey, welcome to Stock Market Mate. In today's video, we'll talk about Peter Lynch's best stock market investing tips. Before we get into it, make sure to subscribe to the channel and hit the notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. The first tip would be, assess if stocks are for you. The stock market can be volatile, so returns are never guaranteed. The average range for stock in a year is 50% between its high and its low. Stocks go up and down, and so does the market. So you should embrace the fact that you could lose your entire investment. If a company does poorly, investors will sell, sending the stock price plummeting, and if you sell, you will lose your initial investment. If you can't afford to lose that, then you should buy bonds. You get an income tax break if you lose money in your stock loss, and you also have to pay capital gains taxes if you make money. Also be ready for the emotional roller coaster that stock investing will give you. In this situation, it's best not to get carried away with the tiniest news. The best thing to do is not constantly look at the price fluctuations of stocks and just check in on a regular basis. On the bright side, investing in the stock market can offer several benefits, including the potential to earn dividends or an average annualized return of 10%. These facts, paired with your own research, should help you to assess whether or not stocks are a good investment for you. Next would be the power of compound interest. Over time, stocks produce better returns than other investments. Stocks have returned for about 10% per year for the past 60 years. Bonds have averaged at 6% a year, and treasury bonds or bank CDs go around 3%. If you look at it now, it definitely doesn't seem like a lot, but this is where the power of compounding will surprise you. Let's say you invest $50 a month and earn 6%. Soon enough, after 30 years, you have over $50,000. When you play with the numbers yourself, you'll find that worksheets do not take taxes into account. The government reduces your return every year once your investments are taxed. Lynch suggests that if you won't use the money for now and you're saving up for retirement, then you should think about placing your investments into tax-deferred accounts, like IRAs, KIOs, 401k, or 403b plans. Here's the really good part. You don't get to pay taxes until you withdraw the money from the account, so the power of compound interest achieves the maximum effect, providing you the best return possible. Interest is often compounded monthly, quarterly, semi-annually, or annually. With continuous compounding, any interest earned immediately begins earning interest on itself. Albert Einstein allegedly called compounding interest the greatest mathematical discovery of all time. This is partly true because unlike the trigonometry or calculus you studied back in high school, compounding can be applied to any aspect of your daily life. It also has the potential to positively impact the growth of your working money and maximizes the earning potential of your investments. But remember, because time in reinvesting makes compounding potentially work, you should consider keeping the principal and earnings invested in order to benefit from the potential that compounding provides. Next would be, stand firm in times of intense market volatility. I've always said, the key organ here isn't the brain, it's the stomach. When things start to decline, there are bad headlines in the papers and on television. Will you have the stomach for the market volatility and the broad-based pessimism that tend to come with it? Says Lynch. Lately, the stock market's volatility is emphasizing what the narrative means. Those who don't expect volatility and can't handle it should look elsewhere to build wealth, although there are a few places where you can build wealth over the long run as effectively as in stocks. Furthermore, Lynch says that you've got to look in the mirror every day and say, what am I going to do if the market goes down 10%? What do I do if it goes down 20%? Am I going to sell? Am I going to get out? If that's your answer, you should consider reducing your stock holdings today. Emotions can greatly affect your performance, and if the market drops, you'll be selling out in a panic, or market surges will make you greedily snap up overvalued shares. The best investors will do the opposite. As Warren Buffett said, it's best to be greedy when others are afraid and afraid when others are greedy. Next tip would be, profit from chaos. Increasing interest rates, bad economic news, wars, elections, these are factors that can push the market down. As Peter Lynch says, no one can predict the market. So as an investor, the best you could do is to know and understand how market crashes occur and how you can work your way around it. We've had over 50 declines over 10% in the current century. Of those 50 declines, 15 have been 25% or more. So about once every 2 years, the market falls by 10%, and about once every 6 years, it falls by 25%. This is just how the market goes. When a recession happens, many good companies may fall whether or not they're associated with their country's issues in wars or banking. Lynch suggests that this is a great time to strike when the iron is hot. This is a chance to buy terrific companies at very cheap prices. Behind every stock is a company. If the company does well over a long period of time, the stock will also perform well. But when the company is lousy, the stock will act accordingly. Lynch further explains that it's all you're betting on. All those things had no effect on automatic data processing. So every time the market goes down, it gives you an opportunity to buy it. Lynch suggests that investors should choose their stock based on their direct exposure to the companies as a consumer or as a professional. He claims that picking stocks whose products or services are highly recommended may give you promising returns in the future. Research the company and its products and services. Ask people why they're using a certain product versus another. Ask them what they think of the product and if they would continue using it for years to come. Check what they like about it. Look for products and services that are the best, those who provide the best value, he says. Pick your stocks wisely. If you start by looking at the entire universe of stocks, there are more than 3,000 stocks on the New York Stock Exchange alone. Plus, there are over 13,000 public companies in total. You will lose your mind trying to go through each one. But lucky for you, Lynch broke down stocks into categories that can serve as guidelines to assist investors make the right decision before picking one. There are basically 5 categories. 1 would be fast growers, 2 would be slow growers, 3 would be cyclicals, 4 would be asset players, and the 5th one would be turnarounds. Companies may not always fit neatly into a particular category. Many are known to have changed categories at some point in time, he says. So first, let's talk about the fast growers. Lynch tells investors to look out for stocks with companies having steady earnings growth and rising dividends, which he refers to as fast growers. He further added that fast-growing companies can expand over 25% a year and they have a knack for defying their size and finding new and exciting ways to grow earnings and give investors plenty of time to get involved. The beauty of investing in these powerful companies is that you have plenty of time. You don't have to be there in the first, second, or third year. They continue to grow for 5, 10, 20, and many more years. Revenues and earnings that grow rapidly are hallmarks of a fast grower, he says. The second would be slow growers. Lynch says some companies have the ability to expand forever at a steady pace as external factors like wars, elections, and rising interest rates do not affect them. One example is the Service Corporation International. This is a slow grower, and Lynch says the company, which is into the business of providing funeral goods and services, grew at a steady rate of 15% year after year. Third would be the cyclicals. Lynch suggests investors to practice caution while purchasing stocks of companies that are directly connected to the economy of a country. Lynch calls them cyclicals, whose earnings can go from spectacular in one quarter to non-performer in another if the economy goes down. Lynch advises investors to choose a strong company that has a decent cash flow and low debt while investing in cyclicals, as they can survive when the cycle goes down. And the fourth one would be turnarounds. Lynch emphasizes that there are a few companies whose stocks have taken a severe beating in the past and have been forgotten by investors but have the potential for growth. Thereby the name, turnarounds. Lynch tells investors that it's possible to try and check the balance sheets of these companies to predict whether they can reverse their trends. If the companies are doing things to improve themselves, coming up with new products, or have been taken over by a new management, or they're cutting costs, it is a good indication that they have the potential for bouncing back. Many turnarounds don't happen, and there are more losers than there are winners. The important thing is to wait for evidence of the actual turnaround to happen. Don't act on the symptoms, he adds. One example is Kresge, which went downhill, but when they introduced Kmart, their stock went up 50-fold. And last but not least, the fifth one is asset players. Lynch believes that many companies have a hidden asset which is not often seen in the stock price. When the stock exchange catches the indications of this hidden asset, the stock can become a runaway hit. A hidden asset is a name, like Disney or Coca-Cola. It's the reputation an old-time company has built up over the years. Though not reflected in the balance sheet, it has incredible value and can be a huge asset when the companies roll out new products. No one can duplicate their products as long as they have those patents, Lynch says. Using these basic principles, Lynch accomplished a lot of fulfilling achievements, and you could too. Just pair it with patience and some research and you could have a promising future in stock investing. If you enjoyed this video, consider subscribing to our channel for more. Thanks for watching, and we'll see you on the next one. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!